my name is Carole Foos. I'm a principal with OJM Group, and I'd like to speak to you today on the post-election tax outlook and fourth quarter tax tips. Thanks for joining us on our webinar today. We do want to let you know that OJM is an investment advisory firm registered with the SEC. As such, we don't want you to consider this to be personalized tax, legal, or investment advice, and you should talk to your professional tax advisor prior to acting on any of the advice in this webinar. As a thank you for joining us today, we would like to offer you a free book. You can see on the screen the 11 books that have been written by the principals of our firm, and we're going to tell you at the end how you can get a copy of one of those. As I'm sure everyone is aware, the elections last week have opened the door to potentially some big tax changes in our country. Because the Republicans will now control the presidency, the House, and the Senate, at least for the next 2 years, it would seem that President-elect Trump's tax proposals may very well get through Congress, pass, and become law, and therefore we may be in for some big tax changes, and that's what we wanted to talk to you about today. First of all, I'd like to talk about his proposals for individual income taxes. The proposals that he has put forth would cut the current 7 tax brackets down to 3 tax brackets. These would be a 12% tax on income up to $75,000 for married taxpayers filing jointly, up to $37,500 for single taxpayers. And taxpayers in this bracket would not pay any tax on capital gains or qualified dividends. The second tax bracket would be a 25% bracket on income from $75,000 to $225,000 for married taxpayers. That second bracket would go up to $112,500 for single taxpayers. And in this bracket, capital gains and qualified dividends would be taxed at a 15% rate. And then finally, the top tax bracket for individuals would be a 33% tax. This would apply to taxable income over $225,000 or over $112,500 for single taxpayers. Long-term capital gains and qualified dividends for this tax bracket would be at a 20% rate. Now, in addition to those, the slimming down of the tax brackets, President-elect Trump has also proposed capping itemized deductions at a maximum of $200,000 for married taxpayers or $100,000 for single taxpayers. This would be items such as medical expenses above the limit, state and local income taxes, real estate taxes, mortgage interest, charitable contributions. In addition to those, he has proposed increasing the standard deduction for those who don't itemize from the current $12,600 for married taxpayers up to $30,000, and from the current $6,300 for single taxpayers up to $15,000. The personal exemption under this plan would be eliminated. So no more personal exemptions. Many of you who have income above $435,000 already don't receive any benefit from personal exemptions, but those would go away for everyone. He would also eliminate the head of household status. So this is the filing status that single parents with dependent children in the house can elect to take. It's a lower tax rate than the single rates. And in addition, he would repeal the alternative minimum tax. So many of you see the pain of the alternative minimum tax on your tax returns currently. That would go away. In addition, he has spoken a lot throughout the campaign about repealing the Affordable Care Act, what many people refer to as Obamacare. In recent days, he's tempered that a little bit and talked about replacing it, but it would seem that he would still plan to eliminate the added Medicare tax of 0.9% on income above $250,000. So that would mean all Medicare taxes at that 2.9% rate, which is split between employer and employee, 1.45% for each. It would also eliminate the 3.8% tax on net investment income. So that's the additional tax that taxpayers are currently paying on interest, dividends, capital gains, rents and royalties, passive investments. It would therefore make the top tax rate on ordinary income a true 33% rate. You know, the top rate now on much of your income is 39.6% plus that 3.8% net investment income tax rate. And it would make the top tax rate on capital gains a true 20%, whereas currently it's 20% plus a 3.8% net investment income tax. A big piece of President-elect Trump's tax proposal is a deduction for child care expenses. He has proposed that families would be able to deduct the average cost of child care expenses. That deduction would be capped at state averages, so presumably will differ by state. It would be an above-the-line deduction for your children under 13. That means it's going to be a deduction on page 1 of your 1040 that will reduce your total income in determining your adjusted gross income. Now, it's not available under the proposal for taxpayers with income above $500,000 if you're married, or above $250,000 for single taxpayers, and it is limited to 4 children per taxpayer. It would, however, include a deduction for stay-at-home parents who are caring for their children or for grandparents who are providing child care. And it would also include an elder care exclusion that would be capped at $5,000 per year plus inflation. So that might be good news for those of you caring for aging parents. In addition, he has proposed spending rebates for child care that would be allowed for low-income taxpayers. On pass-through business income, so those of you who receive business income passing through to you from S corporations, from partnerships, or even income from sole proprietorships, he has proposed that that income would be taxed at a unified business rate of 15%. Now, that's a significant rate reduction for those of you who are currently in the top tax bracket and may be paying 39.6% tax on that income. For corporate taxes, President-elect Trump has proposed cutting the corporate tax rate from the current top rate of 35% down to 15%. However, his proposal says that most business deductions would be eliminated. Now, there's not been a lot of detail surrounding exactly what deductions would be eliminated. He has said that he would allow an immediate deduction for the cost of asset acquisitions for U.S. manufacturers. So similar to the current Section 179 expensing, presumably assets acquired would be able to immediately be deducted, but you would not be able to deduct interest on the borrowing to acquire those assets. So your financing charges would not be deductible. He has also said in his proposal that he would charge a one-time 10% tax on the deemed repatriation of corporate profits held offshore. So money that U.S. companies now have in their out-of-the-country businesses, where under current tax law, those profits wouldn't be taxed until the money is repatriated back into the U.S., those would be taxed currently at a 10% rate. I mentioned that he has said he would eliminate most corporate tax expenses. There is an exception in there for the research and development credit. So presumably that would still be a viable credit to take. And he has also proposed, as was discussed by both candidates during the campaign, the carried interest provision. He would propose a tax on the carried interest at ordinary income rates instead of at capital gains rates. For estate taxes, President-elect Trump's proposal calls for a repeal of the estate tax. Now, currently, estates above $10.9 million for a married couple are taxable at a 40% rate. Under the Trump plan, rather than getting a step up in basis at the time of death, his plan would tax the appreciation in the estate's assets if that appreciation is in excess of $10 million at the time they are sold by the beneficiary. It has been written that there will be an exclusion for small family businesses and family farms. He has also said he would disallow the contribution of appreciated assets into private charities established by the decedent or family members of the decedent in order to prevent abuse. So some advice to consider in thinking about these potential changes. Certainly one thing you have to ask yourself, and we can't really answer this for sure, but when might we expect these tax changes to pass? It has seemed that the talk over the last week among members of Congress and by Trump himself is that this is a high priority, so you would think you would see some tax legislation try to get passed through in 2017. This could mean, if you're a cash basis taxpayer, that you may want to speed up some of your expenses into this year in 2016, and that you might want to defer income to next year. If you think tax rates are going down in 2017, you might want to push that income into next year when it will be taxed at a lower rate. There will be a big difference, an 18% difference in the top tax rate between an employee and a proprietor. Therefore, might make some sense if you've got the ability to be a 1099 contractor rather than an employee, if you meet the definition of such. One thing you're going to want to think about prior to making that change is, do your employer provided benefits make up that difference, or how much of that difference do they make up? In addition, if you have itemized deductions that are above those proposed limits, so above the $100,000 or $200,000 limits, depending on your filing status, and you can bunch some of those deductions into 2016 in order to reduce the deductions below the limits in 17, that would make sense. Keep in mind, however, that the current calculations are saying that these proposed changes could reduce tax revenue by $6.2 trillion. If there are not subsequent laws passed that would generate additional tax revenue, so cuts in spending, entitlement programs being cut, one would think that a sunset will apply to these changes, so they might only be in place for a 10-year period. This is why, again, it's more important than ever to think about tax diversification. If I'm in a period coming up where tax rates are going to be lower, it might make sense for me to fill up that blue bucket of overlooked assets. So think about using after-tax dollars, because your taxes rates are going to be lower. Use after-tax dollars to fill up that blue bucket for items that will not be taxed later when those sunset provisions kick in, or when a new administration comes in and increases the tax rates. But as always, putting money in all three buckets is a great hedge against these tax rate changes that can come along as administrations change and Congress changes. OJM works with clients in many different ways, as you can see on the screen. We have professionals who specialize in asset protection, tax reduction and corporate structure, benefit and retirement planning, insurances, and investments and wealth management. We are a multidisciplinary firm. We've got 1,000 clients in 48 states, and we will plan with you at both the personal level and at the business level. So we're happy to evaluate your asset protection, taxes, benefits, and insurances, either personally or through your business. As a thank you for joining our webinar, we'd love to get you a free copy of one of our books. As you can see on the screen, you can visit our OJM bookstore at www.ojmbookstore.com. Use the promotional code WEB1116 at checkout in order to get your free book if you'd like an electronic copy of the book. We also do offer a free consultation, so you can contact me at the phone number shown on the screen or the email address shown on the screen. Thanks so much for your attendance today. We appreciate it, and we hope you have a great day. We look forward to talking to you in the future.